Welcome to All About Investment Education series by Arohan, focused on demystifying investments for retail investors. In this section, I am very excited to cover stocks. Stock markets have always generated interest in investors because of the availability of real-time prices and their movements. People have made large amounts of money in through investing in mutual funds and SIPs. But there are a set of people who have lost money, who have traded, and there is a general conception that stock market is a gambler's den, right? But our view has been to look at stock market in a scientific approach, and that is the approach we are going to cover in next few minutes. Fundamental view on stock market is that it has been the asset class which has generated highest return over a long period, though its associated risk measured by standard deviation and its variance is equally high. But over the view for next few years is very important because of certain fundamental macroeconomic change which has happened. Overall, we have seen that in the global economic history, different countries have gone through a phase of high GDP growth, 8 to 10% GDP growth, right? When they catch up with rest of the world. Very recently, it is happening to China. It has happened to Germany, to Japan, to Korea, to US. Right? And also with several supportive macro tailwinds, India is likely to grow at an accelerated pace. Right? It may be India's chance that it is doing that catch up, that 8 to 10% GDP growth. Whether it is a stable government, their intent to reform, the inflation and interest rate, downward movement, the major commodity oil price downward spiral, right? Current account fiscal surpluses, right? Now with this, that gives the big opportunities. Government is also trying hard to remove growth hurdles by debottlenecking several initiatives. Corporate profit is likely to expand, but it hasn't done that. So India is at the turning point of economic history. It has, for over many centuries, India was considered to be a slow growth. Only during Chandragupta Maurya, India was considered to be economically developed. Since then, we have seen India growing at low pace, so-called Hindu growth of rate, right, for a entire period, and it missed out on industrial revolution. This year it is on the verge of becoming or already become one of the fastest growing economy in its size. So if we are at a turning point of economic history, the stock market, which is directly linked to GDP and growth, right, has bright future. Within stock market, we have to take a scientific approach. In the next slide, we give you a top-down view of how to pick up a portfolio of themes and diversify so that you can remove the risk of individual stocks. One set of stocks are linked to turnaround in the investment cycle. There is a strong belief that the investment cycle may be turning. It hasn't turned. People expected it to turn little earlier than what has happened. So there is some disappointment. Now, all the capital goods, asset owners, commodities, oil and gas kind of companies are part of this theme. On the other end of economy, we have the consumption theme, both discretionary and non-discretionary. Right? Non-discretionary themes are like defensive themes, FMCG, telecom, media. Discretionary theme is aggressive but more volatile. So auto, that kind of industry will fall here. The third theme is of export-oriented sectors, which are not linked more to domestic indicators, but global economic indicators. And in India, because of its negative trade balance, if India has to do well, this sector has to do well. IT and pharma form part of this. The financial theme supports all three segments. There is a important thing to note is that the growing financial inclusion is the multiplier for this sector. Banking and non-banking companies form part of this. And these are four themes, right? Four legs on which you need to build your stock portfolio. The crux of building a stock portfolio is given in the next slide. Fundamentally, we have to reduce the risk by taking a scientific approach, right, without giving up the gains, right, and making sure that stock market is not looked at as a gambler's den, but we take a scientific approach. So first thing we do is, we suggest is that you spread your investment across sectors to minimize risk. Diversification is the key. Experts can generate more returns by being overweight in sectors that are more attractive to optimize returns, but never compromise on quality. Right? You may add 20% value, right? But quality is the key. Stock markets, whenever such opportunities are there, can have a multiplier effect. And one such things which you can see in the next slide, where you see that if income increases by 10%, right, sometimes the disposable part of income can become 10 times. And that kind of multiplier effect can give exponential growth to certain sectors. Right? Similarly, a GDP growth doubling from 5 to 10%, right, will not mean that cyclicals, right, only grow at the same pace. Cyclicals will probably grow 10 times, right? And the effect of China, right, in a negative way is an example, right, where if the GDP growth in China has from 9% has come from 9% to 7%, the commodity prices have not reduced by 2%, but they have reduced by more than 50%. Within sectors, once we have got the blend of right sectors, then you have to pick up individual securities. Of course, we can tell you, you can use mutual funds, which are a good way. But for people who want to understand how to pick up individual securities, the way we would analyze a specific sector like banking is given in the next slide. But without spending too much of time on this slide, right, what I would like to highlight some of the pitfalls of retail investing. Right? You know, concentrated bets in one stock has never worked for people, and in India, the stock options also create situation where concentrated bets are taken. It is very important that if we have lots of stock options which we are vested, we diversify. If your company does well, you will do well anyway. Second pitfall is over leveraging through derivatives. Derivatives are for expert. You can't leverage. One leverage which you have already created is buying a real estate, taking home loans. That's a leverage buy. If you do trading in derivatives, if things go wrong against you, your entire investment portfolio may vanish. Third thing is emotional maturity. When markets are very excited, retail investors should go and buy. Right? And when markets fall, they are the first one to get scared, right? And not, uh, sell when markets are at low. If you make gains in short term, you sell, make small profits. If you make losses in short term, you declare it a long term investment and keep making losses on that, right? Over trading, right? Thinking you know more than market. There are many retail pitfalls. Stock market is an expert's game, right? It's advisable to leave it to specialists. Please work with mutual funds or portfolio managers who can give you access to this sector. So to summarize, equity always has performed best over long periods and will continue to do so. But in India, it is likely to outperform with higher certainty because of the rapid economic growth in which we find ourselves. It is filled with risks, and you need to diversify. You need to create a diversified set of sectors, right, to invest in equity and do an active rebalancing of this portfolio. Equity investment is a subject of specialization, and you should always take benefit of specialists in this segment to before investing. Right? Mutual funds is already a very good investment, but there are other type of companies who are coming like us who will be able to help you take exposure to equity market. Thank you.